Very good afternoon, investors. You're now on KleverStock with me, Wan Izul, and I'll be serving you the midday roundup with the latest market updates from this morning up until now. We kick it off with Bursa Malaysia updates. The FBM KLCI paused its 4-day rally on Thursday, hovering near multi-year highs as investors displayed caution following a 2.4% gain over the previous sessions. Now, the benchmark index slipped marginally by 0.56 points to 1,710.35. That's in early trade, reflecting a period of consolidation as the market awaited fresh catalysts. Market sentiment was influenced by developments in Washington, where a highly anticipated ruling from the U.S. Supreme Court on the legality of President Donald Trump's global tariffs failed to materialize. Now, the court adjourned without issuing a decision on the Liberation Day tariffs, leaving global trade participants uncertain about the timeline for a resolution. Rakuten Trade noted that despite the local index's slight dip, foreign buying remained a consistent theme. The research house said that foreign buying remained evident on the local market and we expect it to persist. They also pointed to Bursa Malaysia statistics showing that foreign funds were net purchasers of 172 million ringgit in local equities during the previous session. Now, in contrast to the international interest, local participants appeared to be taking a defensive stance. Local institutions were net sellers of 138 million ringgit, while local retailers offloaded a net of 34 million ringgit in domestic stocks. Malacca Securities observed that the negative overnight performance on Wall Street could trigger further profit-taking, given the local bourse's recent extended rally. However, the firm maintained a positive outlook on the index's floor, stating that support for the index was located above the 1,700 level. The morning session saw several heavyweights lose ground to profit-taking. Consumer giant Nestle fell by 1 ringgit 90 cents to 116 ringgit 60 cents, while Petronas Dagangan slid by 44 cents to 20 ringgit 56 cents. Now, the banking sector also faced pressure, with Maybank falling 4 cents to 11 ringgit and CIMB shedding 4 cents to 8 ringgit 31 cents. Hong Leong Bank and RHB followed suit, declining 8 cents and 2 cents respectively. Now, among the active stocks this morning, Capital A eased half a cent to 54 cents after a strong run in the preceding session. Focus Dynamics saw a minor gain of half a cent to trade at 1 cent, while TWL remained unchanged at 2.5 cents. Investors are now looking toward upcoming domestic economic indicators, including advanced fourth quarter 2025 GDP data, to determine the next direction for the market. Moving on to our local currency and foreign exchange. The Malaysian ringgit opened slightly firmer against the US dollar this morning, supported by a decline in United States Treasury yields and a softer greenback as global markets anticipated a more accommodative stance from the Federal Reserve. Now, at 8 a.m. this morning, the local currency was traded at 4.0450 or 4.0550 against the US dollar, and that's up from Wednesday's close of 4.0465 or 4.0525. IPPFA Sidian Berhad, Director of Investment Strategy and country economist Muhammad Siddiq Jantan, noted that the ringgit's performance reflected a broader cooling of the US dollar overnight. He explained that the recent pullback in the greenback suggested that investors were gradually unwinding defensive positions. Now, the analyst also said that the combination of lower US yields and commodity support suggests the ringgit's gains are being driven by macro financial fundamentals rather than speculative flows. Now, the local note also found support in the commodities market as firmer oil and gold prices bolstered Malaysia's trade outlook. Brent crude futures hovered around $64.55 per barrel, while gold prices in Malaysia recently hit record highs above 600 ringgit per gram, tracking a global surge driven by geopolitical uncertainties and also rate cut bets. Now, Muhammad Siddiq Jantan expects the ringgit to remain range-bound with a mild upward bias throughout the day, closely following movements in US yields. Against other major currencies, the ringgit's performance was largely positive. Our ringgit strengthened against the euro to 4.7104 or 4.7220. It also improved against the British pound to 5.4361 or 5.4495. However, our ringgit did see a slight decline against the Japanese yen, trading at 2.5527 or 2.5593, and that's compared to 2.5488 or 2.5526 at the previous close. Now, in terms of our ringgit gaining ground against most of its ASEAN peers, it did rise against the Singapore dollar to 3.1410 or 3.1493. It also rose against the Thai baht to 12.8437 or 12.8841. Additionally, our ringgit edged higher against the Indonesian rupiah at 239.8 or 240.5, and also the Philippine peso at 6.80 or 6.82. Now, the steady performance across regional pairs highlights the relative strength of our ringgit as investors navigate the evolving global interest rate environment. Now we've got some local economic news. Financial institutions globally failed to meet the $2.5 trillion in-trade financing request last year, creating a significant bottleneck for the global economy. That is according to a new survey by the Asian Development Bank, ADB. While the gap remained unchanged since the previous assessment in 2023, it has widened drastically from $1.5 trillion in 2015, representing a persistent lost opportunity for international growth and development. ADB Head of Trade and Supply Chain Finance, Stephen Beck, warned that without sufficient financial backing, the world would struggle to achieve its full economic potential. Beck stated that without the financing to back trade, imports and exports, we're just not going to be able to realize the kind of growth and development that we can from trade. Now, the analyst also further noted that the current policy environment, characterized by tariffs imposed by the United States, is driving a surge in capital demand as businesses scramble to reconfigure supply chains and also diversify trading partners. Now, the report released on Thursday last week suggests that the gap is increasingly tied to the complexity of the new world of trade. Now, Beck emphasized that a lack of adequate financing could make the global transition toward diversified supply chains much more difficult. He said that if we don't have sufficient financing to back that sort of transition, then the transition is going to be more bumpy than it needs to be. Interestingly, the ADB noted that falling energy and commodity prices since 2023 may have slightly reduced working capital requirements for some small and medium enterprises, SMEs, preventing the gap from expanding further. A notable shift highlighted in the survey is the rising role of alternative currencies, including the Chinese yuan. While the US dollar still dominates over 82% of traditional trade finance transactions, nearly 57% of bank respondents now perceive a growing need for local currency options. Now, this shift is partly a response to supply chain reconfiguration that bypassed the United States and a lack of access to dollar liquidity in certain regions. Now, Beck suggested that increasing the availability of local currency solutions could be a key factor in narrowing the financial shortfall. The ADB also pointed out to the growing influence of fintech platforms in filling the credit void left by traditional banks. These platforms, which emerged from a digital boom 5 years ago, are increasingly being used to facilitate trade for underserved sectors. However, Beck noted that deeper study is required to fully understand their impact. As global trade enters a rocky 2026, the ADB continues to advocate for the digitalization of trade documents to increase transparency and attract more private capital into the supply chain ecosystem. Continuing with more economic news updates, Malaysian glove manufacturers are showing positive signs of recovery in their cost structures, a trend expected to translate into higher margins and stronger bottom line performance throughout 2026. Now, Kenanga Investment Bank Berhad noted that recent quarterly results from industry leaders indicate a significant turnaround, with their EBITDA margins expanding as factory utilization rates climb and global demand stabilizes. Now, according to Kenanga, Top Glove Corporation Berhad saw its EBITDA margins rise from 10% in the fourth quarter of 2025 to 14% in the first quarter of 2026. Now, this performance was mirrored by Kosan Rubber Industries Berhad, which maintained margins between 11 and 14% during its most recent fiscal periods. The investment bank said in a note earlier today, "We believe the gradual margins and volume sales improvement are expected to dispel earlier concerns of Malaysian glove makers, less than robust cost structure, leading to margins being crimped." The sector is currently benefiting from a tactical window created by regional supply disruptions. Sri Trung's glove facilities in Thailand's southern hub of Hat Yai have been temporarily suspended since late November 2025 due to severe flooding that is affecting roughly 29% of its total capacity. Additionally, a major Chinese manufacturer's expansion into Indonesia has faced production delays, with commercial output now pushed to the end of the first quarter of 2026. These setbacks have diverted orders back to Malaysian players who are currently trading at deep value levels. Kenanga highlighted that Kosan is particularly well positioned due to its focus on high margin specialty gloves and a disciplined cost structure. They said that the group's profitability is expected to be less impacted by any potential order slowdown. Despite the optimistic outlook, the industry remains wary of the strengthening ringgit, which could pose a headwind for export-oriented revenue. However, lower raw material costs with natural and nitrile latex prices trending downward are expected to cushion the impact. By mid-morning on Thursday, Top Gloves shares on Bursa Malaysia were slightly lower, inching down half a cent to 63 cents, while Kosan dropped 2 cents to 1 ringgit and 5 cents. Analysts suggest that while the sector still faces structural challenges from Chinese competition, the 2026 outlook is the brightest it has been since the post-pandemic slump, and that's supported by US tariff protection and a more balanced global supply-demand environment. Now we'll take a short break, but don't go away. When we return, more corporate news developments. And welcome back to the Midday Roundup. Let's continue with some corporate news updates. Renewable energy player Sunview Group Berhad has proposed a private placement of up to 10% of its issued share capital, aiming to raise approximately 19.02 million ringgit. Now, the funds are primarily earmarked for working capital to support its robust pipeline of engineering, procurement, construction and commissioning projects, EPCC. In a filing with Bursa Malaysia, the group stated that the exercise will involve issuing up to 56.77 million new shares to third-party investors who are yet to be identified. Based on an illustrative issue price of 33.5 cents per share, Sunview expects to utilize roughly 18.52 million ringgit of the gross proceeds for project-related expenses. This includes the procurement of solar materials, payments to subcontractors, and general operating costs for its ongoing EPCC ventures. The final issue price will be determined later with a cap on the discount at 10% of the 5-day volume weighted average market price prior to the fixing date. Now, the group anticipates completing the placement within the first quarter of 2026. The fundraising comes as Sunview aggressively expands its renewable energy footprint. Just earlier this week, the group announced the strategic move to acquire a 100% stake in Jack's Solar Nibong Tebal Sdn Berhad for approximately 55 million ringgit, adding a 50 megawatt large-scale solar plant in Penang to its portfolio. Now, this follows another major acquisition announced in late December 2025, where Sunview agreed to take over a 79% completed 50 megawatt solar plant in Pekan, Pahang, from a subsidiary of Renewco Berhad for approximately 70 million ringgit. Now, these acquisitions are expected to significantly boost the group's recurring income and annual earnings once commercial operations commence in late 2026. By mid-morning on Thursday, Sunview's shares were trading at 38 cents, reflecting steady investor interest in the group's expansionary phase. The company, which listed on the ACE market in 2022, has now fully utilized its previous IPO and fundraising proceeds, and this latest injection of capital is seen by analysts as essential for managing its growing order book and the capital-intensive nature of utility-scale solar projects. Up next, we have some business updates. Malaysia Airports Holdings Berhad, also known as MAHB, is accelerating infrastructure and operational enhancements at Kuala Lumpur International Airport, KLIA, to accommodate the anticipated surge in travellers for Visit Malaysia 2026. During a recent walkabout at KLIA, Managing Director Dato' Muhammad Izani Ghani detailed how the airport operator is refining behind-the-scenes processes such as security screening and queue management to significantly reduce congestion and ensure a smoother passenger journey. Now, a major highlight of these upgrades is the launch of Rimba, a 970 square meter nature-inspired sanctuary located in the satellite building of KLIA Terminal 1. Officially unveiled by Dato' Seri Dr. Wan Aziza Dr. Wan Ismail on January 1st, the space is a comprehensive transformation of the former jungle boardwalk. It features enriched tropical greenery, immersive digital screens, and locally crafted rattan lighting, all designed to provide visual relief and a sense of place for the 50 to 60 million passengers who pass through the hub annually. Muhammad Izani emphasized that these improvements are critical for elevating KLIA's standing in prestigious global benchmarks, including the Skytrax World Airport Awards and the Airport Council International Airport Service Quality Awards. Now, the upgrades extend beyond aesthetics. MAHB has recently invested in 12,500 new passenger trolleys, 100 complimentary wheelchairs, and 210 baby strollers to improve inclusivity. Operational throughput at domestic security lanes has also been doubled, reducing average wait times to under 5 minutes through reconfigured unpacking zones. Looking ahead, the airport's modernization will enter a subsequent phase involving the introduction of premium retail brands and the further optimization of passenger touchpoints such as connection desks. Now, these efforts align with the broader national goal of positioning KLIA as a premier regional hub that reflects Malaysia's natural heritage and hospitality. As Muhammad Izani noted, in this new era, airports must compete on experience as much as efficiency, underscoring MAHB's commitment to making KLIA a welcoming first impression for all visitors arriving for Visit Malaysia 2026. And finally, we'll be wrapping it up with some major corporate developments and deals across Malaysia. Here are the headlines. Sunview Group Berhad has proposed a private placement of up to 56.8 million ringgit, 56.8 million new shares, or 10% of its issued share capital, to raise funds mainly for working capital to support its engineering, procurement, and construction and commissioning projects. Our headline at number 2, Tenaga Nasional Berhad, Electricity Du Lao and Electricity Generating Authority of Thailand have signed an agreement to supply up to 100 megawatts of renewable power from Laos to Singapore. At number 3, the headline reads, Capital A Berhad has disposed of 17 million ordinary shares in AirAsia X Berhad through direct business transactions for cash consideration of 28.1 million ringgit. Our next headline, Keyfield International Berhad announced that KRSB and Petro Laut Sdn Berhad have signed an addendum number 1 to the MOA that will extend the disposal of the DP2 accommodation workboat Keyfield Compassion to between 31st January and 15 February 2026. Our next headline, TRC Synergy Berhad has secured a contract from Gilang Cendana Sdn Berhad for construction project in Putrajaya worth 249 million ringgit. At number 6, the headline reads, Rexit Berhad has officially rebranded as Open Move AI Berhad, signaling its strategic shift from traditional software services to AI-powered digital transformation solutions. And finally, Pestec International Berhad said its wholly owned unit, Pestec Sdn Berhad, has been served with a winding up petition over an alleged $2.4 million by Pestec Engineering Technology Co. Limited. And that's a wrap for the Midday Roundup with me, Wanizo, on KleverStock. Thank you so much for choosing us, investors. And stay tuned for our upcoming live stream programs. We'll see you soon. Thank you.